Baby boomers broadly, people define baby boomers at different times, are from roughly 1945 to 60 or 65, depending on what you want to. So it says that you know, the huge economic booms, everything was possible. Boomers grew up in affluence and with a vision of unlimited opportunity. The resulting drive for self-fulfillment, combined with the sexual revolution, led to a divorce epidemic. It says, yet boomers are driven to compete with millions of peers in the workplace, but are not entirely self-indulgent. They came to define themselves through their work. Generation X. There's 62 million Generation Xers in this country. That might be some of you. In 1965 to 1982. Grew up during a period of great social and economic disruption. Generation Xers grew up to be self-reliant, self-sufficient, and skeptical.
That's me.
They don't trust in the permanence of things.
Right.
They don't trust in the permanence of things, and it says, and in the workplace, they are independent and don't respond well to micromanagement. And I'm a micromanager, and that's why I'm always struggling with people at work. Okay, now this is my favorite. Not one. Millennials. Look at this guy. He's already. Listen to this one. Millennials were born between 1983 and 2001. They were raised by doting parents and awarded praise and trophies for just showing up. They suffer from no lack of self-esteem. Yet they face harsh economic realities thanks to the problems we went through in 2007, 2008. Unable or unwilling to find work, millennials are enjoying a prolonged adolescence, living at home and remaining untested. And I'll add this one, because I see it with a lot of like my friends' kids. They're still on their insurance plans, they're still on their cell plans, they still have parent credit cards, the parents still pay for their car payments, and all. Does any of those things sound familiar?
Yeah.
They sound familiar. It does say that it's still a generation, or it's not all lost, it does show some promise. Millennials are hyper-connected through social devices and instant messaging and texting and all that. And as the social libertarians in their outlook, they are comfortable with diversity in race, culture, and sexual orientation. Millennials are joiners, and they're suggesting that they may actually engender a renaissance of civic participation in this country. So, anyway, I thought that was kind of interesting. And again, yes? This is from 2011, actually.
What about us hybrids?
Hybrids. Well, maybe you have
I'm a hybrid generator, man.
So listen, none of that is 100% accurate, but it's important to understand the time in which people grow up, because it definitely marks and defines who they are and what they respond to. Okay, I am going to jump and do a very quick. I'm going to do a 15-minute summary of credit analysis. Okay, and. This is really outside the scope of the class, but I think it's important because in real estate, we ultimately need to understand credit. Okay, when we talk about credit is extending somebody the ability to pay you. So we talked about cash, right? So we can sell something, right? And we can debit cash and credit sales, right? Just giving you the accounting perspective of that, right? But credit refers to making a sale, and your debit is an account receivable. Okay, I mean, I hate to be so sort of rude about it, right, or brash about it, or brief about it, but it basically says you are going to front money for somebody else. You're going to believe on their promise that they're going to pay you in the future. Does that apply to real estate? All the time. I mean, if we're owners of space and we lease it to people, and if we make improvements, if we buy out their leases, if we buy their furniture and fixtures for them, right? If we're incurring the opportunity costs of letting them occupy the space as opposed to somebody else, we're making an investment in them, and we need to understand right? What their credit situation is like. There's a lot of other reasons why it's important, and I'll talk a little bit about that as well. It may be us as developers. We may be giving somebody a deposit, right? For whatever the reason. We're a construction company and we're making a deposit on material. We're a developer, we're paying somebody for an option, right? What sort of understanding do we have of their credit situation that makes us comfortable that we should give them the money? At our parish finance council meeting the other day, we were doing the whole sort of alarms and cameras and all that at the school. You know, and the first thing the company asked for is they want a 50% deposit. Who is this company? Are they going to be there? Are they just going to take the money and run? So, you know, how do we gauge that? What do we do? How do we mitigate our risk in all these situations? Okay. So ultimately, we're concerned about default risk. In the capital markets class, we talked about a lot of different risks that there are when we deal with money. Specifically, when we talk about credit, we're talking about default risk. And default risk, really, in my thing, I always, you know, the San Miguel theory, right? Happiness is, a happy customer is a paid invoice. So if a customer paid you, he's probably happy, okay? But, for somebody to pay you, two things have to be real. Two things have to exist. What are those two things, Robert?
They have to have the ability and the willingness to pay.
That's it. There, both those things. Ability and willingness. Okay? Sometimes we have the ability, but we don't want to pay somebody. We're not happy with what they did. Sometimes we're very happy with what they did. We just don't have the money. Okay? And in order to have an invoice paid, in order to mitigate that default risk, you need to have both. Somebody's got to have the ability and the willingness. We talked about the other day, when we talked about day sales outstanding or agings of accounts receivable, that the longer an invoice remained unpaid, there was a greater likelihood that one of these two issues was in play. Somebody wasn't happy, or they couldn't pay, right? Because if somebody can pay and they want to, they will likely pay you sooner rather than later. Now, practical experience. If you don't call people, they don't pay you. So just, right? I mean, who pays? Now, maybe as consumers, we pay. But in business, if you don't have somebody calling to collect, people don't pay. So you need to send, you know, reminders. So let's put in real estate context. You know, you got a, you know, multi-tenant building. Send invoices out. You don't have to, right? You got a lease. The lease tells people what to do. If you get into the habit of sending a bill reminder out or an invoice out the 15th of the previous month, if you have somebody knocking on the door or making a reminder call on the 1st, hey, is a check ready? Can I come by to pick it up? You're less likely to have to deal with, hey, they've just breached their lease. It's the 5th and they haven't paid. What do I got to go slap something on the door? And the problem is, I'm not an attorney, but what I do know is real estate, well, in the context of real estate law, landlords are defended or protected perhaps much more so than in other commercial transactions. But you need to follow your contract in order to do that. So, you know, if you've got an apartment building and you let somebody habitually pay you on the 20th of the month, if all of a sudden you try to evict them on the 5th because they didn't pay, you're not going to have a lot of success because you've created a precedent that's allowed that person to pay on the 20th. Now, if you have demanded payment, if you slap the sticker on the door, or whatever the remedies you have in the contract, typically you'll be able to enforce your rights under an agreement, okay? So I'll just keep those things in mind. Now, 5 little tools, 5 little words, 5 simple things to think about. This is from, I'm not a banker, okay? I haven't gone through a credit, course or training program in a bank, but in banks, they talk about the 5 C's of credit. The 5 C's of credit. And it's 5 basic words or concepts that will help us understand or better gauge what potential credit risk we have. So, what is the first C of credit? Character. What's character? Who are you doing business with? Who are you doing business with? Most important thing, I told you guys the other day I was gonna say a story, and I think somebody asked me, I think the question was, how did Cadena, the guy I used to work for, start? And so the story I was gonna say is, so Cadena came from Cuba, and he wound up at Jack's. He came through Peter Pan, so, you know, the mom put him on a plane, he landed here. His sister had married and was living in Jacksonville, so he went to Jacksonville, but he somehow wound up in somebody's house, you know, which was typical for the Peter Pan kids. So most kids wound up in somebody else's house, and he lived in Jacksonville for a few years, and then he made his way back to Miami. So I didn't know that part of the story. But then I said, so what do you do when he came to Miami? I didn't know. So roll the clock forward, it's, I don't know, 2006, 2006, something like that. And I tell Cadena that I'm done, I don't want to do this anymore. I'm tired of being the controller, I'm tired of being the CFO. I want to get more involved in the business. So he calls me in one day and says, hey, there's a little old man in the conference room, go talk to him. Long story short, this guy had a second mortgage on a 460-acre parcel of land that was a landfill in Dade County. And first mortgage holder were some publicly traded bonds. The bonds were in default, and they were about to wind up in bankruptcy court. And in bankruptcy court, the second mortgage holder was going to lose his value. So he came to us to see if we could do something. You know, can you do something? So that was really very fascinating. It was about a year-long process, and we ultimately wound up creating some significant value there. But so the first thing was to try to pin down the bondholder, cut a deal with him. Before we got to that, it got to bankruptcy court, so then we had to deal with the bankruptcy judge. I mean, it got pretty hairy. But when it came time to say, okay, we can pay off these bonds, now I had to get money. And everybody that wanted to do business with us didn't want to touch that a landfill. So, you know, people at B of A, they wanted every deal. They'd always come. Can we take you to lunch? Why don't you give us a deal? You know, people at Wachovia, can you give us a deal? And then I got on the phone and I started calling all these people, right? Oh, well, why don't you give us a deal that's more like what we traditionally do? Well, if you want to do business with us, this is what we're doing. Oh, well, that doesn't fit our portfolio. So we start calling our partners. So we got an exclusive industrial deal in Dade County with A&B. Lose 2 months with these guys, you know, start running around, underwriting, we don't know, we don't think. So I got to come up with the money. I got to come up with the money. And the old man that had the second mortgage said, hey, originally when I owned this landfill, Ocean Bank had a first mortgage on it. He goes, why don't you go talk to Concepcion, the old man who ran the bank, why don't you go talk to Concepcion and see if he'll finance it? So, okay. So I go talk to Concepcion. So Concepcion's this old guy, he's retired now, and he didn't see people. He rarely saw people. But Concepcion, if you got to the bank at 6 o'clock in the morning, you could probably see him. So, you know, talk to the secretary, and she said, come here at 6 o'clock in the morning. So I show up there at 6 o'clock in the morning, and, you know, I go, and he's like, you know, tú eres el hijo de Luis San Miguel, ¿no? Sí, sí. Saluda a tu padre de parte mía. So, connection now. So, you're Luis's son, right? He knew my dad from a not-for-profit. So, now there's a contact, right? Now he knows who I am. Say hello to your dad. Look, here, give your dad this book. And we already had so there's a book that Ocean Bank did that my dad had already given me a copy of it. So he must have had a bunch of copies. He said, give this book to your dad. Okay. So I'm trying to talk. So I'm telling him about this deal that I got. And this guy, so I'm talking, and this guy, he's sitting. So I'm looking at him, and he's sitting, going through all these papers. And I'm thinking, this guy's not listening to me. I need $40 million for a landfill. And this guy's not listening to me. And all of a sudden the guy, he pulls out this piece of paper. And it literally one sheet, it was a trifold paper. And he gives me a sheet of paper and he goes, do me a favor, he goes, take this to Armando and ask him if he remembers these days. And what it was the financial statements of Republic National Bank for December 31, 1964. So the bank had equity of like $2.5 million. So it had a balance sheet, had an income statement, and on the back it had every board member and every employee at the bank. And the last two names on the bank were Jose Concepcion, cashier, Armando Codina, delivery boy. You think we got the loan?
Oh, yeah.
We got the loan. Why did we get the loan? Because he knew who he was dealing with. And he knew that he would get paid back. And in all those years, there were a lot of $40 million loans that Ocean Bank did in those days, but we paid them back. And we paid them back within 9 months. So know who you're doing business with. That'll speak oodles about your ability to collect. The guy who used to run Republic when it got bigger, before Capital Bank bought it and then Regions bought that, was a guy named Luis Botifolo, was an old Cuban guy, and he would always say, I only do business with people that I know. And I don't look at, I look at people. And if I understand what they're telling me, I'll finance them. And Republic was a big lender in the 1960s and 70s to the new wave of Cuban immigrants who built, Miami, really. And it had to do with relationships that people had and understanding and knowing who people were. So most, above all else, character. Who are you doing business with? Capacity. Okay? When we talk about capacity, we just did a case study that had a couple of questions that measured capacity. And we were talking in financial analysis terms, what's capacity? Ability to repay, right? So, and how do we measure ability to repay?
Liquidity?
How do we just did a case study that had a couple of questions on this.
Debt to capitalization.
Not debt to capitalization, but, so in real estate, we talk about debt service coverage ratio or interest coverage ratio. We talk about a company's ability to generate cash flow, or a business's ability, or a real estate asset's ability to generate cash flow in order to service debt, right? So again, I'm not a credit guy at a bank, but what do banks look for first? Cash flow from the asset. That's what they want, cash flow from the asset. What do they look for second?
The person.
Guarantees. I'm talking financially now. They're looking for guarantees or enhancements, okay? What's the third thing they look for? The underlying value. If I got to get it to collateral, what's it worth? Okay? But first and foremost, it's got a cash flow. If it doesn't cash flow, a bank's not going to do a deal with you. Okay? So, ultimately, we talk about ability to repay. Right? What's the third C? Capital. Now, what do we mean by capital?
Down payment.
Skin in the game.
Equity.
Skin in the game. Equity. Right? Equity. How much skin does a borrower have in the game? And said in a different way, and this is going to be the two sort of measures that ultimately lenders look for. If this one talks more about cash flow, this one talks about LTV, right? How much skin in the game does the borrower have, right? So ultimately, going to that third point, if this doesn't deliver, if the guarantees don't deliver, right, then how much is the asset worth, right? Along those lines, which is point number 2, collateral. Okay? So, collateral could be, especially in the context of real estate, letters of credit, right? It could be compensating balances, right? It could be cross guarantees with other assets. Okay, there's a lot of different ways to get to collateral, okay? One of the things you need to be careful with in real estate is a lot of times you say, oh, well, we'll guarantee it. This entity will guarantee it. In South Florida, we have an unusual number of foreign companies. Okay, so a lot of times we'll lease space. And we'll lease space to, Brazil Shoe Incorporated. Okay? Okay? Oh, well, we'll personally guarantee, we'll corporately guarantee this. Oh, well, you know, we're a big subsidiary of, you know, the big Brazil shoe company, right? What you need to make sure of when you're looking for a guarantee is who's ultimately behind the guarantee. Because a lot of companies here in South Florida will say, well, we can't get your parent company guarantee, and it's just a shell. So ultimately, you want to come up to the top, okay? If you want guarantees, make sure you're going to the right level, okay? The last thing that we talk about is conditions. And when we talk about conditions, it's all of the sort of ancillary terms associated with debt. Interest rate, term, repayment, right? You know, maturity. So, character, who you're doing business with, capacity, ability to service, cash flow, capital, how much skin do they have in the game? Collateral, what sort of guarantee can they give you? Conditions, what are the repayment terms? What's the interest you're charging? Okay? What restrictions, what covenants are you going to enter into? Okay? I'm not going to go into the whole, I don't know how many of you have worked in it or had to deal with credit. Typically, credit is done. I'll send you, as part of the case study, I'm going to send you a case study, which is a real estate situation. It is a bit extreme, okay, so this is not a realistic situation. It's a bit extreme, but I think it'll highlight and touch upon all these major, you know, issues. I will send it to you as part of the case study what a credit application looks like. Typically, what happens, for those of you who have been involved, when you want credit, you have to fill out a credit application. The flip side of that is if you're giving credit, you're going to, you know, demand somebody give you a credit application. In that credit application, you're looking for banking references, you're looking for other customers, right? Guy we approved the other day to do the alarm, okay, hey, let's call references. Now, we weren't calling references for credit there, we're calling references to, you know, for satisfaction, but typically, you know, what's typical, you got to provide a banking contact, you're going to provide 2 to 3 trade references that hopefully can validate the person pays on time. You want the other vendor that did it. If you're a landlord and you got a new tenant coming in and you want to check their credit, who do you want to talk to? The previous landlord. Why did they leave? Did they just skip out? Did they just walk out the door? That may not be a case in institutional real estate, but if you've got a 40,000 square foot front-loaded, 16-foot clear flex space warehouse in Hialeah or Medley or Pompano Beach, and you're renting 1,500 square feet at a time, and a mechanic shows up, where was he before? Did he skip out? Did he dump a bunch of oil in the back and skip out? Right? Did he rip off the tenants? You know? So, you want to check that. Credit bureaus, things like Dun & Bradstreet, or other services that provide third-party information on a particular company's ability or history with paying bills. In a lot of industries, there are industry groups of credit managers that get together. In real estate, you don't have that, but it is a small industry. So, hopefully you know other owners or other contractors. Hey, what's been your experience with this client? Do they pay their bills? Do they pay their bills on time? Do you have to harass them? Do you not have to harass them? Okay? To the extent that you have large companies, you've got publicly, you know, available information. Moody's, S&P, Fitch, people that rate debt. Okay, so there's, you know, and ultimately you can do your own financial analysis. Now that you've done a case study, you've had a little bit of a class session, you've done a little bit of a case study, you can do your own financial analysis and say, hey, that company, well, that company's got an inventory problem. Hey, that company's got a receivable problem. Hey, that company doesn't have enough working capital to pay my rent. Why am I going to bother? Why should I make tenant improvements for them? I don't think they've got the ability. Hey, I did a credit check. They haven't paid their last landlord in 6 months, and then they got no liquidity, you know? So you can do your own, you know, analysis, okay? The 2 things that are important in real estate that I would say is, one is, and it's part of a property management function is to update the credit on an ongoing basis, okay? Now, that doesn't happen in real estate a lot. At an institutional level, sometimes it's forced down or pushed down to the asset manager or the property manager, but it's probably not done a lot. Okay, so there might be an initial credit review when people come in, but they don't update the credit. And the reality is, every company should update credit periodically, because conditions do change, okay? And you want to be able to anticipate. The other thing that I was going to say is in real estate, it is common to look for some sort of enhancement when a tenant is asking a landlord to make a significant commitment, okay? So there are a lot of different ways of doing enhancement. So the most basic and common and understandable one is, I want to lease, let's look at residential, I want to lease this apartment. What's the first thing they're going to ask you for?
Deposit.
First and last month.
First, last month, 3 months, whatever. So a deposit. You want to lease commercial space, it's no different. Now, in commercial, people don't want to pay deposits. So you get into a negotiation there, right? Sometimes you get a letter of credit from people. Sometimes you get a guarantee from people. Sometimes you can take a deposit and refund part of it after a certain amount of time. So you ask for a certain amount, and then you're willing to reimburse them after X amount of time of satisfactory tenancy. Okay. You may look for personal guarantees. You may look for corporate guarantees. Okay. And I would say, to the extent that you are expending sums of money. So one thing is the opportunity cost of renting space to somebody who doesn't pay you. The other thing is when you're out of pocket for leasing commissions. What are the other things that we're out of pocket for? Leasing commissions, TI, and what else? And any other sort of out of pocket that we may pay. It could be lease buyouts, it could be signage, right? It could be FF&E, it could be A&E costs that we're paying for tenants. So anytime we're out of pocket, you especially want to be very careful. You especially want to be very careful with credit. I'm going to jump ahead right before we go to lunch, and I'm just going to read one answer from one of the case studies that was given to me. I'm going to read other ones as well. I think you'll enjoy this. But
Comedically or educationally?
the answer is, the largest tenants of SPG are Sears and JCPenney, which are investment grade companies and are considered low risk. Okay, now, I'm not pulling this up. At this point, I really don't remember who wrote that. Okay, so it's not important who wrote it. The reason I wanted to bring it up is, some years ago, we had some excess land. I was running this asset, and Delta was in the market looking for a call center. And it was in fact, our brokerage company was representing them. It's a very, 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 very precise, RFP about this thick out. They knew exactly what they wanted. Had some number of call agents. You had to put all the FF&E in it. Had very specific telecommunication requirements into the building. Had very specific electricity requirements and mechanical systems and parking requirements. Blah 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 blah. It's the hugest thing, and I thought it was a good opportunity for us with the excess land that we had. And in fact, I didn't think it as much as all our development people really wanted it. So I had to call our partner. And our partner said, I don't want to do that shit. I'm like, that's the way he was a New York guy, he's actually a good friend now. He's like, I don't want to do that shit. Well, why not? I said, like Delta, it's like they're publicly traded. He goes, have you checked her credit? I said, it's Delta. They're like on a New York Stock Exchange. He goes, have you checked her credit? And I said, I haven't. Which prompted me to look at Moody's and look at S&P. And 2 years later, we didn't do the deal. And his biggest issue beyond that was that we were going to have to put $400 into a suburban office building, $400 per square foot. And his question was, what do you do with it the day they leave? Nothing, we can't do anything with that building, so, sure enough, 2 years later, Delta declared bankruptcy. And so, and in fact, I don't know who answered that, but Sears and JCPenney's may or may not declare bankruptcy in the next 2 years, but they definitely are not investment grade. Okay, and investment grade is what? Investment grade is what? We'll go over in the capital markets class, but those, you took it, Dustin.
Triple B. B plus?
Okay, right, so in the S&P, it's triple B plus or above is investment grade. And what's below that? What's it called?
Jump.
Speculative. Okay? Let's not call it junk. Speculative,
It's good
okay?
junk.
Junk is like triple C minus, okay? There's stuff between junk and everything above the line, and there's different, I'll give you guys the sort of equivalent for Moody's and Fitch, but triple B plus and above the line is investment grade, and the one thing that we notice from investment grade is that there is a historically high correlation between solvency and meeting obligations and investment grade credit, and a higher correlation with speculative credit and default. Okay, so get very low incidence of default with investment grade credit. But so don't be fooled by the names. The fact that it's a big company, the fact that it's a well-known guy or person doesn't necessarily mean anything. You still got to do the credit, okay? It's Delta, and it went bankrupt, and I look like a fool because I said, "Wow, but it's Delta," and it was Delta. Okay, let's get together and
40 minutes? Yeah.
no. How about like we get together like at 20 up on the 8th?
27 minutes?
Yeah. Listen.